Just to frame it a little bit. So for 2023, obviously the most recent actual, we've got a deficit of 1.7 trillion, which was 6.3%, deficit to GDP. And if we're talking about taking those numbers down to 3%, you're talking about cutting just inside of 900 billion in spending. And to give an idea of the breakdown, apologies for my voice, give an idea of the breakdown, you've got a split here in terms of outlays between what's considered mandatory at 3.75 trillion and discretionary at 1.72 trillion. And then, of course, the interest piece. In the mandatory, the breakout is 1.3 trillion for Social Security, 840 billion for Medicare, 620 billion for Medicaid, 450 billion for income security programs, and then 500 billion in other. And then on the discretionary side, you've got defense. So that total is 1.7 trillion. You've got defense at 800 billion, and you've got 920 billion in non-defense, which includes veterans healthcare, education, and transportation. So, as Emily was saying, I mean, to get 900 billion out of those numbers, it seems that you're going to have to go after the big pieces here. If you're actually going to deliver on that target, you're going to have to go after the big pieces. And as we profiled in the themes deck, the macro themes deck, the Byrd rule or Byrd amendment makes it so that in reconciliation, you can't touch Social Security. So that's off the table. So they're going to have to be looking at Medicare and Medicaid and some of these other sort of big pieces to get, frankly, anywhere close to numbers that would, get the deficit toward 3%. We sort of ran through a thought experiment in the presentation where, we looked at, if you look at total imports in the US in the last year, it was around 3.3 trillion, around 500 and change billion of which came from China. So, if we were to assume that there was no, we'll get to this in a minute in terms of retaliatory tariffs and whatnot, but if you were to assume that, the imports were to stay unchanged and you were to tax or tariff those Chinese imports at 60%, that would generate about 300 billion in change in tariff revenue. And then if you were to tariff the remaining 2.7 trillion in imports at 10%, that of course would generate around 270 billion in tariff revenue. So you basically need just to keep the tax cuts that are there now, right? Because those cost about $1.5 trillion back in 2017 over 10 years. Just to keep those, you need now it's going to cost about 3.9 trillion and about 4.5 trillion fully loaded with the extra interest expense. So that works out to about 450 billion a year, over 10 years. So, if you could get 500 to 600 billion in tariff revenue, the problem is that if you go back to 1929 and you look at that period, 1929 to 1934, global trade volumes declined by 2/3 in response to the Smoot-Hawley tariffs. So, that could get pretty interesting, right? The extent to which, obviously, we move forward and then the rest of the world moves forward with its own retaliatory tariffs. So, in theory, maybe you could get a couple hundred billion in revenue off those tariffs. That would pay for about half the tax cut extensions. And then you would, and this, by the way, is just to keep things where they are, remember. As we showed in our presentation, if you went back to 2016, 2017, and you looked at what actually happened to the numbers, from August of 16, which is the final CBO update before Trump was elected, to June of 17, so obviously post-inauguration and post-passage of the tax cut, the deficit to GDP and debt to GDP numbers increased, right? Deficits got bigger, debt to GDP went up. And if you fast forwarded a few years to the final update prior to COVID, so this is the January 2020 update, the numbers in 2019, which were then actuals, had gone from an original estimate of 3% deficit to GDP to 4.6. And the outlook for 2020 also had grown from 3.3 to 4.6. So, the last time around, things, we got the tax cuts. I don't think we would make an argument, certainly, that they were bad for growth. I think they were good for growth. But on balance, the deficit and debt to GDP numbers got worse. And so I would be expecting that if we're going to extend these tax cuts, I think the plan is to pay for a chunk of them through tariffs. But there's going to have to be massive spending cuts just to get anywhere close to keeping things as they already are. And we're already at 6.3% deficit to GDP. So what I'm saying is it's a very tall order, what he's talking about. And I think, to get anywhere close to that, you're going to have a level of austerity that is going to produce a very, if you're going to cut deficit to GDP by 300 basis points, well, guess what? That's going to come out of GDP growth. So, if you're going to pay it up front, then, we'll take the medicine on the front end. If you're going to do it gradually over the next 4 years, then it'll be, gradual suppression to growth over that time. So anyway, we'll see, but those are a few of the numbers to keep in mind as you think through this thought experiment.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.